Yeah, hi, hello. This is Satyapriya, Assistant Professor, Department of Corporate Secretaryship from Sri Ramakrishna College of Arts and Science, Coimbatore. So let's see, we are going to see about capital structure. So let's see what is capital structure. So the capital structure is a particular combination of debt and equity used by a company to finance its overall operations and growth. Debt comes in the form of bond issues or loans, while equity may come in the form of common stock, preferred stock, or retained earnings. So, these are the contents we are going to see in the upcoming slides. So, under that, first one is definition of capital structure and patterns of capital structure, importance of capital structure, financial break-even point, optimal capital structure, risk return trade off, theories of capital structure, factors determining the capital structure, principles of capital structure decisions, reasons for changes in capitalization. So let's see the what is the definition for capital structure. So according to Jeristenbeck, defines a capital structure of a company refers to the combination or makeup of its capitalization, and it includes all long term capital resources, namely loans, reserves, shares, and books. The capital structure is made up of debt and equity securities and refers to permanent financing of a firm. It is composed of long term debt, preference share capital, and shareholders' fund. So these are the patterns of capital structure to create a new company. So these are the four essential patterns to need to create a company with proper capital structure. Under that, the first one is equity shares only, and second one is equity and preference shares, and third one is equity and preference equity shares and debentures. And fourth one is equity shares, preference shares, and debentures. So this is the importance of capital structure. The term capital structure refers to the relationship between the various long-term forms of financing such as debentures, preference share capital, and equity share capital. The use of long-term fixed interest bearing debt and preference share capital along with equity shares is called financial leverage or trading on equity. This debt is employed by a firm to earn more from the use of these resources than their cost so as to increase the return on owner's equity. So let's see what is financial break-even point. So financial break-even point may be defined as that level of EBIT, that is earning before interest and tax, which is just equal to pay the total financial charges, that is interest and preference dividend. At this point EBIT equal to 0. If EBIT less than financial break-even point, the EPS, which means earning per share, shall be negative. If EBIT exceeds the financial break-even point, more of such fixed cost fund may be inducted in the capital structure. The financial break-even point can be calculated as when the capital structure consists of equity share capital and debt only, and no preference share capital is employed. If that situation, the formula will be financial break-even point equal to fixed interest charges. And second case is when capital structure consists of equity share capital, preference share capital, and debt. In this situation, the formula would be financial break even point equal to 1 plus dp uh, 1 minus t, where I equal to fixed interest charges and dp equal to preference dividend and t equal to tax rate. So these are the point of indifference and uncommitted earnings per share. The point of indifference refers to that EBIT level at which earnings per share remains the same irrespective of different alternatives of debt equity mix. However, sinking fund appropriations for redemption of debt decrease the amount of earnings available for equity shareholders. The equivalency point for uncommitted earnings per share can be calculated as follows. So x minus 1, 1 minus d minus pd minus sf equal to x minus 1, 1 minus d minus pd minus sf, where x equal to equivalency point or point of indifference or break even EBIT level, and I equal to interest under alternative financial plan 1, and I equal to, which means interest under alternative financial plan 2, and T equal to tax rate, PD equal to preference dividend, and SF equal to sinking fund obligations, S equal to number of equity shares or amount of share capital under plan 1, and again S will be number of equity share or amount of share capital under plan 2. So this is a optimal capital structure. The optimal capital structure is said to be an optimal capital structure when a company selects such a mix of debt and equity, which under that point A is representing some minimizes the overall cost of capital, and another one is maximize the earnings per share, and maximize the value of company, and maximize the market value of the company equity shares, and maximizes the wealth of the wealth of the shareholders. And this is a risk return trade off. So financial or capital structure decision of a firm to use a certain proportion of debt or otherwise in the capital mix involves two types of risks there. One is financial risk and another one is non-employment of debt capital risk, that is NEDC risk. Let's see what is financial risk. The financial risk arises on account of the use of debt or fixed interest bearing securities in its capital. A company with no debt financing has no financial risk. The extent of financial risk depends on the leverage of the firm capital structure. And second type is non-employment of debt capital risk, that is NEDC risk. The NEDC risk has an inverse relationship with the ratio of debt in its total capital. Higher the debt equity ratio or the leverage, lower is the NEDC risk, and vice versa. And this is a flow chart to explain what is the risk factor which is affected in market value of the firm. So let's see, in the top position we have a capital structure decision. Under that we have to take debt equity mix, and debt equity mix we have two types of risks there. One is financial risk and employment of debt capital risk. So this risk is combined to the risk return trade off, and the risk return trade off will come to know what is the market value of the firm. Okay, this is the theory of capital structure. These are the main important theories that is going to happening in capital structures. So under that, in first approach is net income approach, and second one is net operating income approach, and third one is traditional approach, and fourth one is Modigliani-Miller approach. Yes. Net income approach. This approach has been developed by Durand. The main findings are the capital structure decisions are relevant to the valuation of the firm. According to net income approach, if a firm makes any changes in its capital structure, it will cause a corresponding changes in the overall cost of capital as well as the total value of the firm. Thus, the capital structure decisions are relevant to the valuation of the. So increased use of debt will increase the shareholder earning. Yes, according to this approach, a firm can increase its total value, that is total value we are considered as a V, and lower the overall cost of capital. Overall cost of capital we are taking like KO by increasing the proportion of a debt in its capital structure. In other words, the increased use of debt will cause increase in the value of the firm. as well as in the earnings of the shareholder. As a result, the market value of equity shares of the company will also increase. Yes, this is the assumptions of net income approach. Let's see the assumptions. So first one, capital structure consists of debt and equity, and second one is cost of debt is less than cost of equity, and third one is cost of debt remains constant for all levels of debt to equity. The use of debt content does not change the risk perception of investment. And the calculation of the value of the firm. According to net income approach, the value of the firm can be ascertained as follows: V equal to S plus T, where V equal to value of the firm and S equal to market value of equity, and earnings available for equity shareholders divided by an equity capitalization rate, and D equal to market value of debt. This is a calculation of overall cost of capital. According to net income approach, the overall cost of capital can be calculated as follows. So KO, which means cost of capital, equal to EBIT into 100, or else where KO equal to overall cost of capital, EBIT equal to earnings before interest and tax, and V equal to value of the firm. So EBIT divided by V into 100. And second one is net operating income approach. Another theory of capital structure suggested but Duran is the net operating income approach. This approach is simply opposite to the net income approach. The main findings are the capital structure decisions are irrelevant to the valuation of the firm. According to the net operating income approach, the capital structure decisions are irrelevant to the valuation of the firm. Thus, if a firm makes any changes in its capital structure, it will not affect the total value of a firm. Increased use of debt will increase the financial risk of the shareholders. The increased use of debt in the capital structure would lead to an increase in the financial risk of the equity shareholders. To compensate for the increased risk, the shareholders would expect a higher rate of return, hence, the cost of equity will increase. Thus, the advantage of use of debt is offset exactly by the increase in the cost of equity. The assumptions for net operating income approach. In that first one is market capitalization capitalizes the value of a firm as a whole, and second one is cost of debt, that is KD is a constant. Third one is increased use of debt increases the financial risk of equity shareholders, which in turn rises the cost of equity. And fourth one is overall cost of capital, that is KO, remains constant for all levels of debt equity mix. And fifth one is there is no corporate income tax. Yes. The various calculations under net operating income approach. Under that, let's see what is value of the firm, and we'll see the formula also. V equal to EBIT divided by KO. That means V equal to value of a firm. EBIT is nothing but earnings before interest and tax, and KO is overall cost of capital. Yes. Second one, market value of equity. We'll see the formula S equal to V minus D, where S equal to market value of equity and V equal to value of a firm and D equal to market value of. And third one is cost of equity capitalization rate. The increased use of debt in the capitalized structure would lead to an increase in the financial risk of the equity shareholders. To compensate for the increased risk, the shareholders would expect a higher rate of return, hence the cost of equity will increase. Yes, the cost of equity, which means KE, or equity capitalization rate, equal to earnings available for equity shareholders, market value of equity, S, into 100. And third approach is the traditional approach. The traditional approach, also known as intermediate approach, is a mix of both the net income approach and the net operating income approach. According to this approach, The prudent use of debt equity mix can lower the firm's overall cost of capital and thereby increase its market value. This approach states that initially a firm can increase its value of reduce the overall cost of capital by using more debt. However, the increase in the value of a firm or reduction in the overall cost of capital is possible only up to a particular level of debt equity mix. Beyond that level, the value of a firm start declining and the cost of capital start increasing. Thus, the manner in which the value of the firm and the cost of capital reacts to change in capital structure can be divided into three stages as follows. So the stage one is increase in the value of a firm and decrease in the cost of capital. In the first stage, both the cost of debt and the cost of equity remain constant. As a result, the increased use of debt in the capital structure will cause increase in the value of a firm and decrease in the overall cost of capital. This is based on the assumption that cost of debt is less than the cost of equity. And the stage 2 is optimal debt equity mix. In the second stage, the firm reaches at an optimal level. The optimal level means the ideal equity mix which minimize the cost of capital and maximize the value of the firm. The stage third one is decrease in the value of a firm and increase in the cost of capital. In the third stage, the value of a firm start declining and the cost of capital start increasing. This happens because the use of debt beyond optimal level will increase the risk of investors. So both KD and KE will rise sharply. So the fourth one is Modigliani and Miller approach, approach. In that approach, part one is if there are no corporate tax. So in that case, Modigliani and Miller argue that in the absence of corporate tax, the capital value of the firm V and the overall cost of capital KO is not affected. But changes in the capital structure, in other words, debt equity mix, is irrelevant in the determination of the total value of the firm. The reason argued is that the increased use of debt in the capital structure would lead to an increase in the financial risk of equity shareholders. To compensate for the increased risk, the shareholders would accept a higher rate of return and hence the cost of equity will increase. Thus, the advantage of use of a cheaper source of finance, that is debt, is offset exactly by the increase in the cost of equity. So the approach assumptions are there is a perfect capital market and companies distributes all earnings to the shareholders. Business risk is same among all firms. Investors are rational and choose a combination of risk and return that is most beneficial to them. And part 2, if there are corporate tax. According to approach, if there are corporate tax, the total value of the firm V and overall cost of capital KO will be affected by changes in capital structure. According to this approach, a firm can increase its total value and lower the overall cost of capital by increasing the proportion of debt in its capital structure. The calculation of value of a firm when tax are applicable to corporate income, the value of a firm is determined by the following formula suggested by Value of unlevered firm VU equal to EBIT 1 minus T and KE value of levered firm equal to VU plus D into T, where D equal to debt and T equal to, and this is our features of sound or optimal capital mix. So under that maximum possible use of leverage, the capital structure should be flexible so that it can be easily altered to avoid undue financial or business risk with the increase of debt. The use of debt should be within the capacity of a firm. The firm should be in a position to meet its obligation in paying the loan and interest charges as and when due. It should involve minimum possible risk of loss of control. It must avoid undue restrictions in argument of debt. It should be easy to understand and simple to operate to the extent possible, and it should minimize the cost of financing and maximize earning per share. So these are the factors determining in the capital structure. Under that, first one is financial leverage or trading on equity, growth and stability of sales, cost of capital, risk, cash flow, ability to service debt, nature and size of a firm, control, flexibility, requirement of investors, capital market conditions, asset structure, purpose of financing, period of finance, cost of flotation, personal considerations, corporate tax rate, legal requirement. So these are the principles of capital structure decisions. In that, first one is cost of principle, risk principle, control principle, flexibility principle, and timing. So capital gearing. So a company can raise finance by using three types of securities. Yes. The first one is equity shares, and second one is preference shares, and third one is debentures. Equity shares are considered as variable return securities because the dividend on equity shares is not fixed and may vary from year to year. On the other hand, the preference shares and the debentures are considered as fixed return securities because the dividend and interest on preference shares or debentures is always fixed. The use of preference share capital and debentures along with the equity share capital in the capital structure with a view to increase earnings available to equity shareholders is known as capital gearing or trading on equity. Thus, the capital gearing refers to the proportion between equity shareholders' funds and fixed interest bearing, and the formula is capital gearing equal to equity shareholders fund, equity shareholder share capital plus reserves and surplus, preference share capital plus long term debt, that is debentures. Alternatively, we have another formula for capital gearing ratio. Capital gearing ratio equal to equity shareholders fund total capitalization, that is equity share capital plus preference share capital plus debentures into 100. And these are the significance of capital gearing. So capital gearing has a different impact on the earnings of available or equity shareholders. Hence, the fixation of a proper ratio between two or more types of securities is essential for maximizing the earnings available for equity shareholders. Under that, the first one is trading on equity. The use of fixed income bearing securities along with equity with a view to increase earnings available to equity shareholders is known as trading on equity. The benefits of trading on equity is enjoyed by the company only if the rate of earnings of the company is higher than the fixed interest or dividend charges. Thus, capital gearing helps in generating additional profits for the equity shareholders at the expense of other forms of securities. And second one is retention of control. Equity shareholders are considered to be the real owners of the company. They enjoy voting rights and participate in decision making process. If a company needs a fund for expansion, it can be exercise various options for raising finance. However, if the existing shareholders do not want to dilute control over the company should prefer funds to be raised by issue of preference shares or debentures. This is because the preference shareholders and debentures holders are not given any voting rights, and as up to a certain level, they also do not participate in decision making process of the company. And third one is trade cycles. In order to improve profitability as well as financial position, the companies usually follow the policy of low gearing during depression period and the policy of high gearing during boom in a boom period. During boom period, the return on investment of the company is usually higher than the fixed rate of interest or dividend prevailing on debentures or preference shares. Thus, during boom period, the company should follow the policy of high gearing. This will improve the EPS, that is earning per share, as well as the financial position of the company. During depression period, the rate of earnings of the company is usually lower than the fixed rate of interest or dividend prevailing on debentures or preference shares. Hence, it becomes difficult for the company to pay fixed cost of debentures and preference shares. Thus, during depression period, the company should follow the policy of low gearing, otherwise both the earnings per share as well as the financial position of the company will suffer adversely. So these are the reasons for changes in capitalization. So reasons are to restore balance in financial plan, to simplify the capital structure, to shoot investors' needs, to fund current liabilities, to write off the deficit, to capitalize retained earnings, to clear on fixed cost securities, and to fund accumulated dividends, to facilitate merger and expansion, to meet legal requirements. So thank you.